This is a complex and multifaceted topic, but I'll do my best to break it down in a way that's easy to understand. By the end of this video, I hope you'll have a much clearer picture of the challenges we face and be better equipped to navigate the uncertain waters ahead. So without further ado, let's get started. Our modern society has become deeply intertwined with and dependent on the global banking and financial system. The flow of money, the extension of credit, and the confidence we place in these systems are essential to the functioning of our economies, the smooth operation of our businesses, and the day-to-day lives of billions of people around the world. However, this deep reliance on the banking and financial infrastructure also means that the stability of these systems is absolutely critical. If confidence in the system were to falter, if the delicate balance were to be disrupted, the consequences could be truly catastrophic. We've seen glimpses of this in the past, with events like the 2008 financial crisis, which demonstrated just how fragile our financial systems can be. At the heart of this issue is the enormous imbalance between the total debt in our system and the actual currency in circulation. The total debt, including government, corporate, and consumer debt, far exceeds the amount of real money, the physical currency and central bank reserves that is available to service that debt. This imbalance is a product of a system that requires constant debt creation and interest payments in order to function. As new loans are made, new money is created, but it's always accompanied by the burden of debt and the obligation to make interest payments. This cycle of debt expansion is not sustainable in the long run, as it puts immense strain on the underlying value and stability of our currency. One concerning trend that has emerged in recent years is the growing interest in development of central bank digital currencies, or CBDCs. These are digital forms of national currencies that are issued and controlled by central banks, as opposed to the physical cash and coins that we've traditionally used. The proponents of CBDCs argue that they offer various benefits, such as greater efficiency, financial inclusion, and the ability to better monitor and control the flow of money. However, there are also significant risks and downsides to consider. With CBDCs, central banks would have unprecedented power to track, restrict, and even seize an individual's digital assets, potentially limiting their financial freedom and autonomy. Moreover, the introduction of CBDCs could pave the way for the implementation of policies like negative interest rates, which could effectively penalize individuals for holding on to their savings. This could have far-reaching consequences for the way people manage their finances and plan for the future. Another fundamental aspect of our current monetary system that is often misunderstood is the way in which currency is created and extinguished. Contrary to popular belief, the majority of the money in circulation does not actually exist in the form of physical cash or coins. Instead, it is primarily created through the process of lending and borrowing, with banks issuing loans that effectively create new money in the form of bank deposits. As these loans are repaid, the money that was created is then extinguished, effectively reducing the overall money supply. This means that the value and stability of our currency is heavily dependent on the continuous expansion of debt and the ability of borrowers to service that debt. The implications of this are profound. It suggests that the money we hold and use on a daily basis may not have the same inherent value and stability as we might assume. The value of our currency is ultimately tied to the health and resilience of the broader financial system, which is increasingly vulnerable to shocks and imbalances. Interestingly, many central banks around the world have been steadily accumulating gold reserves in recent years. This is a significant shift from the past, when central banks were more focused on diversifying away from gold and towards other financial assets. The fact that central banks are now actively increasing their gold holdings suggests that they may be preparing for a potential future instability in the current monetary framework. Gold has long been seen as a safe haven asset, a store of value that can withstand the ups and downs of the financial markets. By stockpiling gold, central banks may be signaling their concerns about the stability of the existing monetary system and the need to have a more reliable anchor in times of crisis. Another critical factor to consider is the increasing interconnectedness of the global financial system. In today's world, economic events and policy decisions in one country can have significant ripple effects across borders, leading to widespread consequences that are felt by individuals and businesses around the world. This high degree of interdependence means that the stability of the global financial system is now more fragile than ever before. A crisis or disruption in one part of the world can quickly spread and destabilize markets and economies in other regions, making the entire system more vulnerable to systemic shocks. The role of the Federal Reserve and its influence on the markets is also a key aspect of this discussion. The Fed, as the central banking system of the United States, wields immense power over interest rates, the money supply, and the overall health of the financial markets. Through its policy decisions, the Fed has the ability to manipulate market conditions and even create asset bubbles. This has been a growing concern as the Fed's interventions, such as the implementation of quantitative easing QE programs, have been widely criticized for contributing to the inflation of asset prices, particularly in the stock and real estate markets. The seeds for the Fed's current approach to monetary policy were planted by former Fed Chairman Ben Bernanke, who in 2002 laid out a roadmap for using tools like quantitative easing to prevent deflation and support the economy. Bernanke's actions and philosophy have had a profound influence on the way the Fed has operated in the decades since, with the central bank becoming increasingly reliant on QE and other unconventional monetary policy tools to prop up the financial system and stimulate economic growth. However, this approach has also been criticized for creating asset bubbles, distorting market signals, and ultimately setting the stage for the potential unraveling of the current monetary framework. As the Fed continues to navigate the challenging economic landscape, the legacy of Bernanke's influence looms large. One of the fundamental issues at the heart of this discussion is the general lack of public understanding about the nature of our monetary system. Most people assume that the physical cash and coins they use in their day-to-day transactions are the primary form of money in circulation. However, the reality is much more complex. In fact, the majority of the money supply is actually in the form of bank deposits and digital bank reserves rather than physical currency. This dual nature of money, with both physical and digital components, is critical to understanding the fragility and potential vulnerabilities of the current system. Many people are unaware of the fact that when they deposit money into a bank account, that money is effectively transformed into bank credit, which the bank can then use to create new loans and expand the money supply. This process is central to the way our banking and financial system operates, but it also means that the stability of the overall system is heavily dependent on the confidence and trust placed in these financial institutions. In conclusion, the issues we've discussed today paint a concerning picture of the fragility and instability inherent in our current currency and banking systems. The enormous debt imbalances, the potential risks of central bank digital currencies, the nature of how money is created and extinguished, and the growing global financial interdependence all contribute to an increasingly precarious situation. As we move forward, it's crucial that we develop a deeper understanding of these complex issues and the implications they hold for our individual financial security, the resilience of our economies, and the overall well-being of our societies. Only by arming ourselves with knowledge and being proactive in addressing these challenges can we hope to navigate the uncertain waters that lie ahead. Thank you all for tuning in today. I encourage you to continue exploring these topics, engage in discussions with others, and stay informed about the ongoing developments in the world of finance and economics. Together, we can work towards a more stable, equitable, and sustainable monetary framework that serves the best interests of us all.